Welcome everyone, my name is Peter Iosif. Together we'll be going through a discussion about the week ahead in the markets. Before we start though, allow me to show you our risk warning and our disclaimer. Remember please that our products are traded on margin and carry a high level of risks, and it's possible to lose all your capital. Now these products may not be suitable for everyone, and you should ensure that you understand the risks involved. Also, as a disclaimer, the information in this webinar should not be considered under any circumstances as an investment advice or investment recommendation, instead as educational material only. Now, as an opening, 2021 has come to pass, and we have entered the new year with market turning on the engines in a haste. Now, the release of the Fed's December meeting minutes and of the US December employment report, which at the moment is still pending, seem to have awakened up the market from the Christmas holidays. In the coming week, we expect the markets to be also quite turbulent given the financial releases expected. We make a start on Monday, the 10th of January, with the release of Australia's building approvals for November, while on Tuesday the 11th we note the release of UK's GDP rates also for November. On Wednesday the 12th we highlight the release of the US CPI rates for December, and on Thursday the 13th we get from the US the weekly initial jobless claims figure. On Friday the 14th of the month we note the release of China's trade data for December, and we highlight the release of the US retail sales growth rate for the same month. On the monetary front, we note Powell's testimony before the US Senate Banking Committee for his reappointment as Fed chairman on Tuesday the 11th of January, while a number of other policymakers from central banks across the world are also scheduled to make statements as well. And with no time to waste, we move on to the USD, and this would be the USD index for our chart. Note how the index has been moving in a sideways motion practically over a month now, since the end of November. The index's price action has been limited between the 96.65 resistance line, which was tested here. To the downside, we note the 95.60, which was tested once, twice, while practically the price action seems to be revolving around the 96.15 line, which currently serves as support. Note that it has served as support here, as a resistance here, support once again here. To the upside, we note the 97.20 also, and also an ultimate bullish scenario, the 98. To the downside, besides the 95.60, we also note the 94.95. Note also that the RSI indicator below the 4-hour chart is near the reading of 50, implying a rather indecisive market. Now the USD ended 2021 in the greens, while it seems about to end the first week of the year on the front foot as well, after getting a push from the release of the Fed's December meeting minutes. Once again, we note that December's employment report is still to be released, hence there is still some volatility for the USD ahead as the week draws to a close. Now the content of the minutes had a hawkish tone and showed the extensive concern of the Fed's policymakers for the inflationary pressures in the US economy. It's characteristic that Fed policymakers generally noted that based on the outlooks for the economy, the US employment market, and the inflationary pressures in the US economy, it may become necessary to hike the federal funds rate sooner or at a faster pace than before expected. It should be noted that the release of the minutes created some bearish tendencies for the US stock markets, which ended Wednesday in the reds, yet they instigated a more general risk of sentiment in the markets. On the monetary front, we note practically in the coming week the testimony of Fed Chairman Powell before the Senate, and we expect the senators to grill Powell as a nominee for reappointment about the bank's intentions, as he is up for reappointment. Now, Powell will have to be a bit more political in order to gain the Senate's favor. Yet, should he reaffirm the bank's hawkish approach, we may see the USD getting some support. As for financial releases, USD will have to wait until Wednesday, when we get the US CPI rates for December. A possible deceleration of the rates could be signaling a retreat of inflationary pressures in the US economy, and thus the release is expected to be closely watched by traders. On Thursday, we get from the US the weekly initial jobless claims figure, as well as December's PPI rates. On Friday, USD traders are to have an even more busy day, as in the American session we get December's retail sales growth rate, December's industrial production growth rate, and January's preliminary University of Michigan consumer confidence indicator. Please note that the pre-mentioned data affect economic areas such as growth, employment, inflation, and consumption. And with no time to waste, we move to the pound, and this would be cables for our chart. Now, cable has been in an upward motion. That's from around the 23rd of December onwards. Note how it has tested the 1.36, which is also practically our first resistance line. On the flip side, I would highlight that the RSI indicator below the 4-hour chart has a slight downward slope, which is nearing the reading of 50, implying that the bullish tendencies may be easing for the pound. Levels to be noted to the upside besides the 1.36, we also note the 1.3720 and the 1.3830. To the downside, we note the 1.3430, which practically provided resistance, however also some commotion here, so it was noted also as a support line here. Lower than that would be the 1.3280, and the lowest level noted in our chart would be the 1.3160, which provided support twice in the past. Now, GBP has ended the year slightly lower than when it began against the USD, and cable presented bullish tendencies in the first week of the year. On a fundamental level, the UK seems to be still troubled by Brexit, and it's characteristic that new post-Brexit custom rules come into effect and could have an adverse effect on the UK economy. It should be noted that in the UK inflation is building up, with companies being reported to plan for price increases at the rate of 5% in the coming year, according to a Bank of England survey as reported by Bloomberg. It's also characteristic that the leader of the House of Commons, Jacob Rees-Mogg, told the cabinet on Wednesday that a tax hike should be shelved as energy bills and inflation surge once again, as reported by the same media outlet. Now, the economic phenomenon present not only in the UK now turns the attention of the market to the Bank of England, and whether the bank would be willing to proceed with another rate hike in order to curb inflation. It seems that there are hawkish expectations on behalf of the market for the BOE, yet the bank may be undermining the prospects of the economic recovery of the UK by such moves. Now, as for financial releases, we note Tuesday the 11th of January as the main day of interest for GBP traders, when the GDP rates, the industrial output growth rate, the manufacturing output growth rate, and the trade balance, all for November, are to be released. Special focus is expected to fall on the GDP rates, as the release could show whether the growth of the UK economy remained sluggish or not after October's disappointing rates. Moving now to the Japanese yen, and this would be USD JPY's 4-hour chart, a pair which has been moving practically in a sideways motion despite some bullish tendencies in the previous day. It has corrected lower and practically submerged below the 113.70 resistance line, which provided resistance in the past month a couple of times, but also some support at some points. To the upside, we also note the 114.45, which provided resistance around the 18th of November. and higher than that would be the 115.45, also providing resistance around the 23rd, 24th of November. To the downside, we note the 112.75, which provided support once, twice, 3, 4 times, but even further back, that was around the beginning of November. And lower than that, we also note the 112.10, and the lowest level noted would be the 111.30. Now, JPY has closed the year considerably lower than when it began against the USD. Now, the losing streak seems to continue from 2021 as JPY is in the reds for a 5th consecutive week in the first days of the year. On a monetary level, the release of the Fed's meeting minutes and the constantly supportive dovish stance of the BOJ seem to keep the Japanese currency pinned at low levels. Overall, the bank is expected to keep its ultra-loose monetary policy in place to support the Japanese economy, given that also, despite some inflationary pressures in the Japanese economy, the CPI rates are still a long way from reaching BOJ's goals. Yet also JPY seems to have suffered extensive safe haven outflows, as the market increasingly looks past the Omicron variant, which is considered to have mild effects, thus may have been somewhat removed from the danger zone. As for new COVID-19 cases, Japan is still at low numbers, yet the recent rise in the number of new daily cases seems to have ringed the alarms in the land of the rising sun. Japan is now reported ready to declare a quasi-state of emergency for 3 prefectures, including Okinawa, which has a substantially sized cluster, as per media reports quoting Japanese government officials. We would like to highlight the statements made by Japanese Finance Minister Suzuki, that he is closely watching any impact of currency moves in the economy. Now, should JPY continue to weaken, we may see inflationary pressures in the Japanese economy building. Now, despite expecting safe haven flows to remain the main driver behind JPY's movement, we would also like to note that on Wednesday, we get from Japan the current account balance for November, which you can practically see in the graph in front of you, as well as December's corporate goods prices growth rate on Friday the 14th. Moving now to the euro, and those would be euro USDs for our chart, also in a sideways motion between the 1.1370 and the 1.1225. Practically, the price action has been moving since the end of November, revolving around the 1.13 level. Now, we note that the pair could remain in a sideways motion between the pre-mentioned levels, for the time being at least. However, there seem to be some bullish tendencies present for the pair, yet we would require clear breaking of the 1.1370 before actually switching our sideways bias in favor of a bullish outlook for the pair. To the upside, besides the 1.1370, which has proven its worth twice here, we would also note the 1.1435, which was a support line and has now turned into a resistance line. Also a prior support line which has now been turned into resistance line would be the 1.1515. To the downside, besides the 1.13, we would also like to note the 1.1225 and even lower the 1.1165. Now, the common currency ended the year substantially lower against the USD, but also lost ground against the pound, but not the yen. The euro seems about to end the first week of the year near the same levels as it began against the USD. Fundamentally, it should be noted that Europe is still in the firm grip of the pandemic, given that Germany and France have still a high number of new daily cases. Now, the issue could threaten the pace of economic recovery for the zone, and is still ongoing, given the threat of the Omicron variant of the pandemic. In the economic scene, inflationary pressures in the area seem to recede, given that in December the acceleration of the inflation rates halted in France, while in Germany the headline rate even slowed down as per December's preliminary releases. Now, the slowdown of HICP rates for December seems to be easing the pressure on the ECB to act in order to tighten its ultra-loose monetary policy, as the point made by various ECB officials that December and January are to be turning points for inflationary pressures in the Eurozone seem to be confirmed. Nevertheless, it should be noted that ECB official Kazakhs yesterday stated that no one should doubt that the ECB stands ready to act if inflation accelerates. As for financial releases, Euro traders are to have an early start next week, as on Monday we get Eurozone's forward-looking Sentix index for January, which you can see in the chart on your screen. Note how the index has been dropping since July from 29.8 to 22.2, 19, 16, a short recess, yet a correction even lower in December, and that is indicative of a pessimistic sentiment for the short-term outlook of the Eurozone on economic level. We also get Eurozone's unemployment rate for November on the same day. On Wednesday, we note the release of Eurozone's industrial production growth rate for November, while on Thursday we get France's final HICP rates for December. Finally, on Friday, we get the release of Germany's GDP rate for the full year of 2021. Moving now to the Aussie, and this would be AUD-USD's 4-hour chart. Now the pair dropped considerably. Note the wide drop which was performed in the previous days, landing it practically below the 0.7170. The RSI indicator is clearly below the reading of 50, nearing the reading of 30, which tends to imply a bearish sentiment for the pair. And it was also characteristic how the pair's price action stabilized once it hit the lower Bollinger Band here. Note how the 100 moving average has altered its slope to a downward one and it's about to cross the 200 moving average. All of that tend to align towards a bearish outlook, and we tend to maintain it for the time being. Nevertheless, to the upside, we would like to note the 0.7170, which prevented during today's Asian session the pair from actually ascending, breaking above it, and start once again aiming for 0.7230, which is our next resistance line. Higher than that, we also note the 0.7290. To the downside, the first resistance line, should the bears actually take over, could be the 0.71, which actually provided support once, twice here, even despite the false break. Lower than that would be the 0.7045, and the lowest level noted in our chart would be the 0.6990. Now, AUD ended 2021 lower against the USD, while on a weekly level, AUD-USD seems to be also in the reds. On a fundamental level, Australia was reported to have suffered a record number of COVID infections, practically straining businesses and supply chains. It should be noted that on Sunday the 2nd, the Australian government had stated that the mild effect of the Omicron variant could allow the country to reopen the economy by shifting focus from the number of new daily infections towards hospitalizations. In general, the situation with COVID does not support the Aussie, which as a commodity currency relies on solid good international trading terms for the appreciation of its value, and is also considered to be a more risky trading instrument. At the same time, the interest rate differential outlook between the RBA and the Fed seems to underscore the dovish stance of the RBA, as the bank had repeatedly stated that rate hikes are not to come earlier than 2023. Yet market analysts insist that the bank may still start tightening its monetary policy by tapering its QE program early this year, thus indirectly acknowledging the possibility of a lighter adverse effect of the Omicron variant. Now, as for financial releases, AUD traders had to have an early start for the week, As on Monday, we get Australia's building approvals for November. On Tuesday, we note the release of Australia's final retail sales growth rate for November, as well as the country's trade data for the same month, which you can see practically on the screen in front of you. Note how the trade surplus has been shrinking for practically August, September, and October. At the same time, we must note that the imports growth rate has been on a downward slope. The important part though here is that exports have accelerated their growth rate, and that was for the month of October. Now what we want to see for November is whether the export growth rate will be able to surpass the import growth rate and practically provide the stance for the trade surplus to be on the rise once again, breaking the weakening streak of the past 3 months. Other than that, we would be also highlighting Chinese data. Aussie traders are also to be keeping an eye out for China's inflation metrics for December on Wednesday, while Australian exporters of raw materials could focus on the release of China's trade data for December, especially the import growth rate on Friday. Moving now to the CAD, and this would be USD CADs for our chart. Now the pair had dropped yesterday considerably, breaking below the 1.2775 and testing the 1.2710, which actually held its ground. It's a quite valid support line right now. Lower than that, we also note the 1.2645, which proved its worth once, twice, and lower than that would be the 1.2585. To the upside, we note the 1.2775, which provided resistance but also support, while higher than that would be the 1.2855. Note the resistance, how it reversed the upward motion of the pair around the beginning, actually the 3rd to the 4th of December. Higher than that would be the 1.2950, which also marks practically the highest priced action of the pair in our chart. Now, despite some considerable strengthening of the loonie at the beginning of the year of 2021 against the USD, the pair ended 2021 with CAD being around the same levels as it began. On a weekly level, the loonie seems also to be relenting the gains made the week before. It should be noted, though, that Canada's December employment data are still pending, along with the US employment report for the same month, so the direction of the pair could still alter for the week. Now, given the lack of high-impact financial releases from Canada in the coming week, we expect fundamentals to take over the initiative over the market's opinion for loonies direction. On a fundamental level, we note that the risk of sentiment displayed by the markets at some parts of Wednesday and Thursday seemed to weaken the CAD, which as a commodity currency is also considered as a more risky trading instrument. We expect this correlation of market mood and the CAD to continue to be displayed in the coming week, and whenever the market mood is more risk on, CAD could be getting some support and vice versa. It should be noted that even the rise of Canadian yields was not able to help the loonie, as US yields were on the rise as well in the past few days. On the COVID front, we note that Canada is passing through the worst pandemic wave. Please note that since past month, some Canadian provinces have announced some restrictions in order to curb the spreading of the disease. Also, on a fundamental level, we note that CAD traders could also be keeping an eye out for oil prices, as Canada is a major oil producing country. It should be noted that WTI prices have been on the rise since the 2nd of December, and should the bullish tendencies continue for oil prices, we may see the loonie getting some support. Now, overall, as a general comment, in the coming week in the FX market, the USD could dominate again, especially from Wednesday onwards, given the market mood, but also the dispersion of financial releases, when we get more heavyweight US financial releases at the last 3 days of the week. Now, beyond the FX market, note that the release of the Fed's meeting minutes caused a risk of sentiment which brought US stock markets on the back foot, especially Nasdaq. On the other hand, the negative correlation between the USD and gold seems to have been maintained, and we would not be surprised to see this be extended in the coming week as well, with the release of the CPI rates, the US CPI rates, being in the epicenter of attention, as gold is also being considered a trading instrument to hedge against inflationary pressures. As a last comment, we would like to discuss possible trends in the coming year. Now, definitely the uncertainty is still present regarding COVID and may continue to affect the markets in the year, especially should new variants emerge. Hence, trading the markets may be somewhat rocky. Also, on an economic level, we would expect growth to be solid as economies reopen and recover, hopefully with supply chain issues easing. Inflationary pressures are expected to be also present, which could force central banks to make a hawkish shift. Also, we highlight the possibility of geopolitical tensions with an increased risk factor for the markets, both on a political level as well as a military level, and both could have economic implications, especially given the rising tensions in the US relationships with Russia and China on a global level, but also on a local and regional level, such as Turkey, for example. That should sum it up for the week. From all of us here at IronFX, best wishes for solid trading.